Hello everyone, my name is Sidiki Tambasa. Welcome to this training session on conducting a sensitivity analysis as a tool for capital budgeting. What is sensitivity analysis? Sensitivity analysis show how different values of an independent variable affect a dependent variable under a given set of assumptions. It is also called a what if. Most of the time, in real world, companies use sensitivity analysis to identify opportunities or mitigate risk and communicate decisions to upper management. Basically, sensitivity analysis helps us understand how changes in certain variables impact a project's financial outcome. Why use sensitivity analysis in capital budgeting? Particularly, we use it to identify key risk factors impacting project success, support better informed investment decisions, help prioritize order for further research or risk mitigation. Here is the step-by-step process: quantitative approach and qualitative approach. For the qualitative approach, we need to identify key input variables that influence project outcome, define a range of values for each variable, analyze potential risks and uncertainties affecting assumptions, develop alternative scenarios to reflect different possible outcomes. For the quantitative approach, we need to adjust one variable at a time while keeping others constant, recalculate financial metrics such as net present value and IRR, compare results to assess impact on project viability, use graphs or tables to visualize the impact of changes. With sensitivity analysis, you can change one variable at a time. You look to see how the outcome change as a result of changing one of the inputs. Here we're gonna do one practical exercise, and in this particular exercise let's consider Apple income statement. The Apple income statement, as you see in the screen, so in this slide presented here, we have a sale of $2,175. So in this exercise for a capital budget, we gotta determine the sensitivity of net present value to 10% changes in investment, revenue, and discount rate. So in the practical exercise, to calculate the net present value, we need to calculate first the operating cash flow based on the income statement of Apple. And then from the project information in the previous slide, we need to determine the NPV. So the NPV here for the base case is $1,779. So after all calculation, the sensitivity analysis shows us here in this table the net present value is more sensitive to changes in revenue, plus or minus 30%. For the investment, we see here the investment have a significant but smaller impact, plus or minus 25%. Based on discount rate, we see the discount rate changes have a lesser effect on the project. As explained in more detail previously, now for incorporating risk in capital budgeting, we might use sensitivity analysis to identify critical risk area, apply risk-adjusted discount rate for high-risk project, and combine with scenario analysis for robust planning. So, the majority of capital budgeting is basically driven by the assumption. In our particular cases, for this analysis, you see the two major of risk factor are investment and the revenue. But the revenue is more difficult because you cannot predict how many units you are going to sell. So we are arriving at the end of our presentation. So this is your reference, and in conclusion, now remember, in your analysis, whenever you get an NPV negative, that is a dangerous sign, and that is where you need to focus your analysis and to see, well, if there is an existing possibility to improve the chances of getting a better value for that, or if it's something we need to think, or maybe something that need more strategic reflection. Thank you.